So this is the critical part of Greeks. Is, believe it or not, it's not the hard either. Okay? So, Greeks. What are the Greeks? There's delta. So delta is basically, the definition means the value of the option that will increase or decrease with the stock moving $1. Agree? So it's going to basically, it tells you how much you're going to make or lose for every dollar move in the stock. If you're betting on the stock going up and it moves $1, how much do you gain? 1 delta. If the stock goes down, you lose what? 1 delta. You guys understand that? So basically a dollar movement in the stock relates exactly to what? Delta. Everyone okay? Yes? Yes? Now, our profits and everything are based on deltas. Everyone agree? Yes? Now pull out your phone. Yeah? Pull out your phone. Everyone? I want you to compute something for me. Let's say you have a 5% movement. What's 5% on a $10 stock? 50 cents. Is that 1 delta? Or is that half of a delta? It's half of a delta, isn't it? Because 1 delta is equivalent to $1 move. So a 5% movement on a $10 stock would be what? Half of a delta, agreed? Yep. So that's what? 1/2 delta. Everyone okay? What's 5% on a $20 stock? $1. So that's what? 1 delta, agreed? How about a $40 stock? 2. So that's what? 2 delta, agreed? And how about 50? Let's say 60. 60 is what? 3 deltas, agreed? Yes? Now, let me ask you something. What is the chances of a stock moving 20%? Slim. What's the chance of a stock moving 10%? Slim. Right? What's the chance moving a stock moving 5%?
It's not possible.
It's high because of earnings, don't you? Yeah? In earnings, what does happen with stocks? They typically move 3 to 5%. Are you okay with that? Yeah? Everyone okay with that? Yep. So, you have earnings and you're trading a $10 stock and it moves 5%. How much do you make? 1/2 of a delta. Is it worth your time? If something moves 5%, I want to be making some good money, shouldn't you? Right? Because if you're not, is it worth your time? No. So should you be trading stocks around 10? No. If a $20 stock moves 5%, you make how much? 1 delta. Is that worth your time? Not really. What if a $40 stock move? That's what? 2 delta, agreed? And maybe we could get the other delta from the other delta from Vega. So we could start looking at 40 and above, can't we? Yes? You guys see that? Yeah? So, is it worth us looking at any stocks below 40? Not really. Unless 30 is the boundary condition, because if you think it could move 10%, then you could drill with $30 stocks. Everyone good with that? Yeah? And I'm going to show you an example where a student told me, let's bet on this stock going down. So we bet on this stock going down, right? My option is only at worth 80% and the market's tanked what? 10%. There's something wrong with that picture, isn't it? Yeah? The market tanked 10%. I'm sorry for you guys, but I'm expecting 400 or 500% return on my options. And the only reason why I'm not getting that is because the stock is what? A $20 stock. Does that make sense? And I'll show you that a little later. Everyone good? So does everyone understand delta? Yes? So delta dictates that we trade stocks what? Greater or equal than $40. Everyone good? Yes?
Yes.
And Jessica?
Yeah.
Okay, I gotta hear yeses. Now theta is a time value option that increase or decrease every day. We know for a fact when you buy signals that most of the time decay occurs 30 days of expiration. Agreed?
Yes.
Yeah?
Yeah.
So what we're going to do is we're going to say we're not going to worry about theta because we're just going to exit the option 30 days before expiration. So I don't have to deal with theta. Everyone good? Now, after the first dollar move, delta changes. If it increases or decreases by gamma. Everyone good? Let's think worst case scenario and say gamma is irrelevant. It's just going to be bonus for us when we get it. Everyone okay with that? Because we think worst case scenario, so I don't want to know if delta increases. I'm going to assume delta is always going to be the same for every dollar move. And whenever I get money from gamma, it's bonus. Everyone okay with that? So I don't have to worry about gamma. Everyone good? So all I need to know is what? Delta right now, and I don't need to know theta, gamma. Everyone okay with that? And? Jessica? Okay. Next one is volatility. So I do need to know volatility. Volatility is basically the value of the option that increase or decrease with 1% change in volatility. So if volatility increases, I make X Vega dollars. Volatility decreases, I make or lose X Vega dollars. Everyone agree? So every time volatility changes by 1%, or right, that's how much I lose is the Vega value. Everyone okay? And?
No, thanks.
So listen to this. If volatility increases, agreed? If for every 1% that it changes, the Vega tells me how much I'm going to make or lose.
Okay,
You okay with that?
right. So
Just like the
that
delta.
That could be more than $1 then.
We don't know. Whatever the Vega value is, 10 cents, 20 cents, 30 cents, whatever it is, for every 1% change in volatility, it tells us how much we're going to make or lose. You okay with that?
Okay.
Now, I haven't showed you how to use the delta Vega yet. Agreed? All you know is if the dollar changes in price, if the dollar moves up $1 or down $1, the delta value tells you how much you're going to make or lose of the option. You okay with that?
Okay.
Volatility moves up or down 1%. This tells you how much you're going to make or lose. Are you okay with that? Yes?
Yeah.
Jessica?
Yep.
So all we need to know is what? Vega and delta. Everyone good? Everything else we've thrown out the door. Because why? We're assuming we're stupid. We want to keep things simple. Everyone good? Any questions so far? And go ahead.
So is there a relationship between delta and Vega?
No. Nope. One tells you how much you're going to make or lose with the dollar movement. The other one tells you how much you're going to make or lose with volatility moving. That's it.
And is it a flatter, like, so is 3%, it was a 3% change in volatility, doesn't increase more, the Vega would increase more, is the more?
No. Here's what you're going to do. Here's your normal value. Agreed? That's your reference point, right? If it's expensive, everything to the right is what? Expensive. Agreed? Everything to the left is what? Cheap. And everything right here is what? Average. Everyone okay? Yes? So every time you move over this scale over here, your Vega what? Is getting what? Higher. Let's say you buy an option what's expensive and it's right here. Agreed? Sooner or later, it's going to come back to the average. Agreed? Let's say you're off by what? 3% away from the average. Sooner or later, it's going to drop down to 3%. Agreed? So if you bought it here and it was 3% higher, when it comes to the average, you're going to lose 3 times Vega, whatever that value is. So you're going to lose 3 Vegas in money. Do you see that? Do you see that? So what we're going to do is we're going to determine what the average is here. Yes? We're going to know what that is. That's going to tell us if we're expensive or not. And when we look at the strike price, it'll tell us the IV. We're going to compare this IV to the average. If the IV is lower than the average, then we know that it's cheap. If the IV is equal to the average, we know it's what? At the average cost. If this average IV for the option strike price a month is higher than the average, then we know it's expensive. And by how much, we're going to compute it. Are you okay with that? Everyone good? Yes? So we're going to go for a PowerPoint to compute this now. And then what we're going to do is we're going to go to a real life example. Everyone okay with that? Yes? Okay. So now, here is my entry. Everyone see this? Yes? My entry is at what? $30.11. Everyone okay with that? Yes? Hello? You guys sleepy or what? This is the time to be active.
This is, okay, yeah, this is a breakout.
This is a breakout trade. My yellow line is my entry. It's at $30.11. Everyone okay with that?
Yeah,
I'm telling you all this stuff. My preserve mode is 33.
yeah,
Everyone good?
yeah.
My stop is roughly around $29 and $28.98. Everyone okay with that?
Yep.
So if I compute this, my reward is from where? Here to here, which is basically $30 minus 33 minus 30.11, so that's 2.89. Everyone okay with that?
Right.
That's roughly how many deltas? 3. And you good with that?
Yeah.
Jessica?
Yeah.
Ludovic?
Yep.
Anthony? Daryl?
Yes.
Okay. My risk is from where? Entry to here. So I compute the dollar risk, which is $1.13, which is roughly equivalent to what? 1 delta. Everyone good? Yes? Any questions so far? That's pretty simple, isn't it? Yeah?
Yeah.
Please stop cheering at the chart. Thank you. You're really freaking me out. Because there's nothing more there. This is something you should be doing. I don't know, but I mean, this is reward risk, isn't it? All you're doing is taking the dollar values and saying, for every dollar move, that's 1 delta. So that's roughly equivalent to 3 deltas. There's nothing special here. You okay with that?
Yeah.
Good. Stop freaking out. Now, it's time to freak out. So, do you see my screen here? Yes?
Yeah.
The earlier chart, we were betting on it what? Going up. So we're looking at the what? Calls. And in here, I'm looking at the 31 strike price. So I'm betting this stock is going to go to $31 by what? April of 2013. Everyone good? Yes? And the current price is $29. Everyone okay with that? Yes? And?
Yeah.
You're good with that?
Yeah.
If I look at the strike price, my delta, which is right here, is telling me it's 22 cents. Agreed? Which is right here. You okay with that?
Right.
My cost, if you look at my bid ask, is 25 cents by 35 cents. If I split it, what's my cost? 30. So do you understand the cost now? My delta is 22. My cost is what?
30.
Is everyone okay with this?
Yep.
Jessica? Okay. Now, if I come back here, I had 3 deltas, agreed? Yes? And my delta is equivalent to what? 22 cents. Agreed? So 3 times $22 is what? 66. So based on my delta, I can make $66 in profit to my preserve mode. Are you okay with that?
Yeah.
Because remember, we figured out from the option chain, delta is worth what? $22. And we're going to have 3 deltas here, so 3 times 22 is 66. Is everyone okay with that?
Yeah.
Jessica? My risk is what? 1 delta. We know delta is what? $22. Agreed? So in here, I'm going to risk $22 to make 66. Everyone good? Now my cost, my option is what? $30. Agreed? So out of 30, if it goes down $1, I'm going to lose what? 22. Agreed? So how much is left? $8. So if it goes down $1, right, and I exit the trade, I'm going to still preserve $8 of the 22, of the $30 I made. Everyone good? Yes?
No, I just got lost in
Repeat
that
that
last
again.
bit.
How much does the option cost me?
30.
30. If it goes down $1, how much am I going to lose?
22.
What's 30 minus 22? So the option price is going to go 30 to down minus 22 is going to go to what? 8 cents. So on a $1 move, the delta was so huge compared to the cost. Now on the first $1 move, I'm going to lose majority of my value in that option. So it's only going to be worth 8 cents. Everyone see that?
Right.
Yes? If it goes up, it's not an issue because I make what? 66 cents. Everyone see that? Yes?
Yeah.
Or no? Yes? Okay? My point here is that when we put an alert, when it gets to $1, let's say we're going to get stopped out and we lose, right? The option's only worth what? 8 cents. Is it worth closing out? No, because you're going to have commission going in, commission going out. It's not worth it. Let it ride and see if maybe it comes back. If you close out a trade and it's worth 10, 15 cents or higher, then it's worth closing out. You guys see what I'm saying here? Everyone good? So really the risk on this trade is not $22, it's what? 30, because it's not worth closing out the trade. You guys see that? And now, do you have a good reward risk? No. So is this trade worth it? No. Ludovic, you got it? Anthony? Daryl? And Jessica? So even though it looks like $22 is a risk, it's not. It's really going to be 30 because this delta is going to be so much of how much we paid. Are you guys okay with that? Okay. Any questions so far? No? Yes? No? Hello?
No.
So now, here's my question for you. In the old classes, I could show you how to determine the average IV. And it's a long, tedious process of extrapolating on a chart. And let me give you an example. You'll go to Profit and Thinkorswim, you show a average IV chart for a year, and then you interpret where the middle is, and it'll be subjective, and you come up with that value. Agreed?
Yeah.
That's the way we did it, the old way, where we teach you this, and we went for the old way. Now you could just go to the website and pull it off the value.
Nice.
You guys see that?
Yep.
Do you want to learn the old way?
No.
It's not worth it. Because I'm telling you now, you can't get as accurate as we are doing now. Okay? So, the new method, now, what you're going to do is you're going to go to the website. I'm going to go to the scanner. Everyone good? Yes? I'll show you this guys later on how to set up everything, but let me reset my profiles. And all I'm going to do is come to General, type in Apple, and it's going to show me the average IV, which is right there. You guys see it? 24. Yeah? Yeah?
Yeah.
If you don't see it, all you have to do is go to column view and check it on, which is average IV, and it will appear. Click on update, and it will show at the bottom. Everyone okay with that? So what's our average IV for Apple?
24.
What? 24. Agreed? So now, watch what I do.
So that average is over how long?
Sorry?
How long is that average?
Over a year.
A year?
Over a year. We have been looking at some 2 years and 3 years, but the problem is there's so much distortion in there that this is more accurate. Okay? By the way, most people would charge you a lot of money just to determine that value. I mean, ridiculous amount. It's stupid. Okay? But it's all built in. Everyone good? So now, what was the average?
24.
What the hell did the handy dandy notepad. So the average IV was what? 24. Is everyone okay? Now, based on our technical analysis, it says Apple is going to go up. Everyone okay with that? So I'm going to come back to the trade tab here, and let's look at November. Everyone good? Yes? Now in here, whoa. If you look at it, we're looking at November 11s, right? What's the IV for that option? It's what? 31, isn't it? Yes?
Yeah.
Yes or no?
Yeah.
It's for which strike price? November
100.
11th, hundreds, and it's what? 31.56. Everyone okay with that?
Yeah.
Now, is this cheap or expensive?
Expensive.
It's expensive, isn't it?
Yeah.
Yes? Now, by how much? How much will we lose? Let's determine that. It's expensive by how much percent?
7.
So 31.56, now you're doing it correctly, minus 24% is what?
7.56.
7.56%. Everyone okay?
Yeah.
Which is equivalent to how much Vega? So that's equivalent to, let's just say 8 times Vega, which is 8 times, what's my Vega value? If you look over here, my Vega is what? 12 cents. Everyone see that? Yeah?
Yeah.
So that's equivalent to what? $96, isn't it? Yes? So I'm going to lose, when volatility comes back to normal, how much? $96. Is everyone okay with that?
Yeah.
Yes?
Yeah.
Anthony? Ludwig? Jessica? Yes or no? You should be looking at my screen, not your notes.
We've got to write that down otherwise.
Well, you're going to get a recording, so what's the purpose? You want me to if you want, I'll shut off the recording.
No. Oh, don't do that.
Then I was you to stop taking notes, i.e. Jessica. If you want the, let me put it this way. If you want the recording, stop taking notes. Because I want you to tie in my words with the notes. Do you see what I'm saying to you? Otherwise, you know me, I don't give out recordings. So this is a privilege. That means please put down the pen. Okay? So do you understand it now, Jessica, or no? So let me go through it again. We said this is expensive because the average, the normal is 24. The IV for that option is 31.56. So it's above the 24. So we figured out it's 7.56 above the average. You okay with that? So we know that for every 1% of volatility change, we're going to make or lose 12 cents. Agreed? So if average IV goes from 31.56 down to 24, it's going to change by 8, right? Vegas. We know that every Vega is worth 12 cents. So 12 times 8 is $96 we're going to lose just for the IV to go back to normal. You see that? Even if the stock doesn't move, I have a potential of losing what? $96. Everyone understand that? Yes?
Yeah.
So, if Apple remains where it's at and IB goes back to normal, how much we're going to lose? So, look at this. My cost is going to be what? 258 by 64. What's the midpoint? That's 4, 6, so 3, so 61. $2.61. So it's going to cost me $261 per contract. You okay with that, Jessica? Yes? And if the stock Apple does not move, I could lose $96 of that 256. What percentage is that?
30%.
30%. So without the stock moving, I have a potential of losing what? 30% of the value. How's that sound?
Not bad.
Crappy, isn't it? Now Ludwig's like, yeah, you know what, but guess what? I think the stock's going to move good, so I can still make money. Right? Let's test Ludwig's theory out. Let's assume that he's going to make $3. Everyone good? It moves $3. You okay with that? What's that, 3%? Roughly? Yeah? Ludwig? So if it moves $3, that means I can make 3 what? Deltas. Agreed? Yeah? Which is equivalent to, what's my delta value? 40 times 3 is what? 120. Agreed? Yes? So now I take my 3 deltas minus my IV crush, as I call it. Yes? Which is 120 minus 96 equals to what?
24.
$24. Stock moves 3% and you only make $24. How do you feel? Crap. Do you see that? And Jessica? Anthony? Now, do you understand how IV is critical? Yeah? It's a do or die on you making money or losing, right? What if the IV was there to help you? What if that option price, the average IV, yes, is IV is 24 and your stock IV was 20. Agreed? So then it's cheap by what? 4%. And then what happens? Right? 4% is what? Equals to what? Come on, help me out, guys. Sorry? 4 times Vega, which is equivalent to 4 times what? 12. That gives me what? $48 plus. Agreed? So now if I have 3 deltas, move. Agreed? I make 120 plus what?
48.
48. What's 48 of 120?
168.
No, what's 48? What's the percentage of 48 of 120?
Oh,
1/3, isn't it? So you just had a 30% increase in your option in how much you just made just off IV. How does that sound to you?
Pretty good.
Right? It's incredible, isn't it?
It is.
Yeah? What do you think? Yes?
yeah.
So what do you need to do? You need to find things that what? Technically tell you they're at a support resistance, and IV's what? Really low.
Yes.
You can't really do wrong, can you? Now, let's go for a scenario. When the markets go up, what happens with IV?
Goes down.
IV goes what? Anthony?
Goes up.
No, goes down. It's an inverse relationship. When the markets go down, as they are, IV goes what? Up. You're okay with that? Yes? So let's say I bought Apple, bought calls. You okay with that? I bought these November. What are these? November.
100.
Sorry?
100.
100 calls. Everyone okay with that? Yes? Ludovic? Yeah, everyone? Now, when I bought them, right, let's say IV was 20%. Everyone okay? What the hell just happened here?
It
20%. Everyone okay?
You've got 11 calls.
Huh?
You've got
November 11. Don't worry about that. You okay with that? It cost me, let's say, how much? $248 per contract. Is everyone okay with that? Yeah? Vega was in this example, Vega is what? 12 cents. Yes? And delta is what?
40.
40, right? Yeah? Now, stock today drops 3%. Agreed? 3% on Apple is what? 3 deltas. Agreed? What's that equivalent to? $120 minus. Agreed? Yes? IV goes up 5%. What's that equivalent to? 12 times 5 is what?
60.
60. So net, I lose how much?
66.
Isn't that great? Yeah? But guess what? With the panic going on for the last couple of days, right? My stock only moves down that, but my IV moves down what? 10%. So now what? 10 times what? 12 is what?
120.
So I'm at what? Break even, right? So guess what? Some of my calls that I had are showing me break even. What do? Exit at what? Break even. My chart's telling me I'm stopped out, right? But guess what? Did I lose on those? Wow. Look at that. The stock's market drops. The stock drops, but I get to get out at break even. How do you like that? What do you think? Yeah?
Answer.
What do you think, Jessica?
Very good.
It's pretty good, isn't it? Look at the average IV today. It's what? 30, right? Yes?
Yeah.
Look at 5 days ago. What was the IV of Apple?
24.
How much did it sit there move up?
6.
6, right? Yes? So it moved up 6%, right? So write that down, 6%. Okay? And Apple was $100.06. What? $100.08 5 days ago. Today, it's what? 97.54. That's 2.5 deltas, agreed? Yes? Now, just with the deltas and gammas, which are not correct, that we're using today, how much did the stock drop? 2.5, right? So that's 2.5 deltas. What's that? Each delta is 40 times 2, that's 80 plus half, that's 100. So I lost what? 100. And IV, how much did I make off IV? It went up how much? 8%? 6? Yes? So 6 times what? 12, equivalent to what? 72? So net, I'm down how much? Let's just say $30, agreed? And the stock, the option cost me what? $2.60. What percentage is 30 of 264?
Sorry, what percentage of what?
$30 of 264. 11. Right? How do you like that? Did your portfolio take a hit? No. And I'll tell you this now. This is a live trade. I'm at break even. You know why? My Vega is not 12 cents. My Vega was 18. So 18 times 6 is what? 96? So what am I down? $4? Wait a minute. Market just tanked 10%. And on my positions, I'm bullish. I'm only down what? $4? What would you do, Anthony? I would close it out and say I'm going to wait for the IV, the Greeks, to get on my side and get in a better strike position, wouldn't you? Because guess what? I'm no longer at 100. Maybe I could get a better strike, better option at what? 97.50, can I? Yeah? So, guess what? When the market's tanked on all my bullish positions, what do? Exit close to break even. If they're not break even, I got out. You guys see what I'm saying? So what am I looking at doing? Repositioning those bullish positions, right? And on my puts, guess what's happening on my puts? On my puts, I'm making money off what? Delta and what? IV. You guys see that? Isn't that huge? What do you guys think? You guys are not comprehending this, right? I don't know about you. You should be excited.
Yes.
Yeah.
I just showed you, even if you're wrong, you're still going to be able to get out of break even
Yes.
if you understand the Greeks.
Yeah.
If you buy it expensive, I'm sorry, you got no way of doing it. But if you bought it cheap, if you bought that option cheap, and the markets go against you on those calls, IV is going to go up so much, it's going to take care of the delta to a point you still could get out of break even. Right? And then your put positions, what? You take a bonus round.
Yes.
Right? How much can you make? Let me show you what happened in 2008. Now, how you could take $1,000 and turn it easily into a six-figure number, which will be coming up in our markets. Watch.
So your next book options round would be even cheaper because the market's tanking.
Well, watch this. If you look, there's a product called a VIX. VIX. Everyone see this? Yes? Look at the daily time frame. So, wow, look at this. I could do an Ichimoku chart on this, right?
Yes.
Yeah? So, remember, volatility is what? Inverse relationship, right? So if the IV is going up, what's happening to the market?
Going down.
Going down. So look what happened here. IV was going down. That means the market's going what? Up. All of a sudden, this damn thing goes what? Up. And then it closes above the cloud, agreed? And look at my momentum. Where is it? Bullish. So this thing does a cloud breakout, pivot, pull back, and then holds here. At this point right here, this is bullish, isn't this? A setup to go what? Long, isn't it? So that tells you this market was posing to what?
Tank.
To tank. You guys see that?
Yep.
You didn't see it on the E-minis that this market was going to tank. You didn't see it on the ES. However, you saw it on what? The VIX. You see that? So then, guess what? Even if you're not sure, right? Buy some stock positions. They're bearish. Find them with cheap IV. Yeah? And you're ready to go, aren't you? And I'll show you how to do that in just a moment. Because I'll show you exactly what I did. Right? And then look at this. If IV in the market went from 15 all the way to 32, that's a what? That's a 15% movement in the market, right? You're seeing Apple move 6%, right? Today, at the all-time low, do you think IV on Apple was 6%? Those 13.2. When the VIX was up here and the markets were at a low, Apple's IV was what? What did I say? 13.2. So guess what? I exited my Apple position with what? A profit. How's that sound? Well, if that's not juicy enough for you, watch this. If that still doesn't excite you, opportunities come and go. Do you guys believe that?
Yeah.
And if you're sitting there looking for the opportunity, you have a potential to capture it. You agree to that?
Yeah.
If you're not looking for it, will you get it?
No.
So watch. I want you to see how I got all my money back from when I lost in 2000. This right here is 2008. You guys see that?
Yeah. Right.
Look at what happened. IV went from where? 12, to about 13, 14, or somewhere there. Look, let's say 20 to 89. Your stocks had anywhere from 120 to 150% increase in IV. So guess what happened? I made more money off Vega than Delta. Delta was the crumbs. The loaf was the what? Vega. You guys see it? Now, would Ichimoku tell me I need to be better on the market going down? Well, here you go. I need more data. It's going to come in a minute. I'll show you in a minute. If you look at the end of 2007, for the first time since 2003, we actually closed below the cloud on a weekly time frame for the E-mini S&P 500 futures. Since 2003, we never had achieved that. You guys see that? I'll show it to you in a minute once this data comes in. That's huge, isn't it? Yes? So, in theory, right now, with the way the markets are going, right? When you see the markets are going higher, what does that mean for you guys?
IV's going lower.
IV's what?
Going lower. As the market's going higher.
Market going higher means what? IV is going what?
Down.
Lower. That means you have to be careful, don't you? Yes?
Yeah.
Even if you buy it cheap, can it still go lower?
Yeah.
Yes. So how do you handle that? You got to make sure you go far enough that you give it time for it to come back to the average IV.
Right. Okay.
You guys understand that? Yes?
Yeah.
So as the markets kept on going higher, making all-time high, should you have just sat there and do nothing? No. All you have to do is what? Go out 1 or 2 months longer than you normally do. You guys okay with that?
Right.
Yes?
Yes.
Yes? If the markets, why is it saying marketing? Well, one day I'll learn English. One day markets are going lower, what happens to IV? Is going higher. Agreed?
Yeah.
What's that mean?
Time is your enemy.
Why? Even if you make the stupidest mistakes, guess what? Volatility will take care of your stupid delta move. You guys see that? Now, let me ask you something. Based on what you just learned, right? Do you make more money on the markets going sideways or going up or going down?
Up and down.
Sorry? Directional, isn't it? Then guess what? Why do they teach you all these other non-directional strategies? These non-directional strategies, if you listen to them, with the vertical spreads and iron condors, they're telling you can make 8% a month. What is 8%? Inverted reward risk. We're talking 300, and they're talking what? 8%. Why? Are they capturing volatility? Are they making money off volatility? No. Not at all. You guys understand that? Let me give you another example of someone being lucky. Ever heard of Karen the Super Trader?
Yeah.
Yes? So Thinkorswim Tom Sosnoff has been bragging about this lady called Karen the Super Trader, how she turned a couple of $1,000s into millions by selling naked puts. Right? Well, guess what? If you're at the right place at the right time, it would happen, wouldn't you? So she decided to start trading when? At the bottom of the stock market. When the markets hit a what? Low. So if the market's at a low and they're going to go higher, right? Yes? When a market's at a low, what's IV at? At a high. So if you sell when it's at a high, is that good or bad? It's good. Because when the IV goes lower, guess what? She makes the money on Vega going the other way. So she didn't know she got in at the bottom, and she started selling all these naked puts 6 months, 1 year out. All of a sudden, market goes up. Guess what happens to her? Cha-ching.
I think she did say she's finding it hard to make money.
On the market's what? Going higher now.
Yeah.
Why? Because when the market's at an all-time high, what's IV at? Low. Is it good to sell in a low environment? No. And even if she does, she may make money, but it's pennies. And when a market like this just sat there tanked, all the profits that she'd made just got wiped out in one day with IV. You guys see it or no? Yes? Do you understand how this works now?
Yep.
Yes? Critical? So where's your money at? Vega. Yes? Now watch. I'm going to show you this and we're going to go to lunch. So when I'm ready to buy, yeah, I just come over here to this option filter. Yeah? And I want volatility, I want it low, and I want it 5% or higher. And it's going to pop out everything today with what? Low IV. Is there anything? Nothing, is there? Right? Let me see, reset these defaults. Hold on. So the market's just tanked. Do you think you're going to be able to find a lot of options without no? But if you do, guess what? It's an anomaly, isn't it? So, all I'm going to come down here, option filter, I want to find everything 3% or more so I can make, oh my God. Look at this. This is 3% lower than the what? The average. Holy cow. Isn't that cool? Yeah? Now, let's do this. Let's get a little greedy. Let's come to daily. And I only want what? Bullish trades that are above the cloud. Look at that. On the daily, agreed?
Yep.
Let's say I want all the trades that are bullish on what? The weekly. There you go. Out of 8,500 stocks, guess what? You just narrowed it down to what? These. You guys see it?
Phenomenal.
So, when I saw the VIX at the bottom of the strategy, what did I do? Just come over here, found everything that was a 4, a Ichimoku breakout strategy that was what? Bearish, right? Because I'm looking for bearish trades. And IV was what? Low. And I just closed my eyes and put them all on. You guys see it?
Yeah.
Because if this is at 3% below the average IV, agreed?
Yeah.
That means I'm going to make 3 Vega dollars right then and there.
All right.
You guys see that? Yes? Any questions? Now I gave you something to think about during lunch.
Awesome.
Any questions before I wrap up Greeks? Do you understand the Greeks? Yes?
Yes.
Okay, did my part. Lunchtime.